to learn more about how organizations can preserve their strategic optionality during this time of crisis. But before we begin, I just want to mention a couple of housekeeping items. During the presentation, the audience will be on mute, but that doesn't mean you can't ask questions. Please feel free to type in your questions in the chat or the question box in the webinar pane. Also, our panelists will be taking the questions towards the end of the presentation as time allows. We have a lot of content to cover, so please keep your questions towards the end. And lastly, we'll be recording this presentation and we will be sending you the deck and the recording 24 hours after the webinar. So with that, I'm going to hand it over to Chad, who's one of our speakers for today.
Thanks, Sarah. Hi, I'm Chad Zredek from Ormanino. Just going to quickly go through the agenda here. We'll introduce ourselves as a panel, walk through the current situation that we're all experiencing, guide through the path through this uncertain times, talk about some options, and then take Q&A at the end. So Sarah, next slide, please. We will be, so I'm Chad Zredek. I am a managing director at Ormanino, and I lead our transaction advisory services practice from a financial due diligence standpoint. And I'd like Michael to introduce himself next.
Thanks, Chad. My name's Michael Hogan. I'm a managing director in the corporate finance and restructuring team at Ormanino. Ormanino is one of the top 25 largest tax audit consulting firms in the US, and we serve primarily privately held companies, nonprofit, and public entities across most industries. We have offices located throughout the West and Midwest regions of the US, and we provide also global services through our partner More Global. I have about 30 years of experience, and I lead the corporate finance and restructuring practice, and we focus on helping companies in distress or facing challenges drive their recoveries or to help in building soft landings. After me is Robert Ruff. Robert?
Thank you, Michael. Robert Ruff, I'm a managing director and co-founder of Telos Capital Advisors in Dallas. Telos Capital is a FINRA licensed investment banking firm. We are dedicated to helping middle market companies, those with revenues from about 8 million to 100 million, with either a sale process or in raising debt or equity capital. I've been working on transactions and restructurings for about 40 years and enjoy helping owners solve their financial problems. And now I'll turn it over to Brandon Tittle.
Hey guys, Brandon Tittle. I'm a shareholder in at the firm Ferguson Braswell Fraser Kubasta. I lead the bankruptcy financial restructuring practice. Ferguson Braswell has offices in Plano and Houston and Silicon Valley. It's basically a full service business law firm that specializes in IP and patent litigation. We specialize in mostly middle market type clients with assets or gross revenue of 10 million upwards to 100 million. My practice area is primarily debtor work. After law school, I clerked for Judge Walrath in the District of Delaware and Judge Truss in the Eastern District of New York, and also received a LLM in bankruptcy law after law school. Since then, I've worked at large firms doing both international and national bankruptcy cases. But since being at Ferguson Braswell, we, like I said, we do mostly middle market debtor cases.
Thank you all. Sarah, can you go to the next slide, please? So we've been in the midst of COVID now for over 2 months, and it has, quite frankly, impacted everybody. And many, hopefully all of us, have been asking, what is my cash position? How is my plan adapting to how the market changes? And quite frankly, just what are my options? And it's different for everybody. So in working with our clients, it's kind of been a progression of what we're seeing. So initially, the early stages of grief, which was denial and anger, all this stuff was, uncontrollable. And so we're just faced with, reacting to things out of our control. More recently, a lot more bargaining, especially with lenders, and only really limited acceptance by sector in terms of, accepting the reality. Most everyone has been focused on extreme short term, PPP, getting initial cash infusion in. But as we're learning, this COVID crisis is really a marathon and not a sprint. And so, Brandon, I'd like to ask you, how is this downturn different from the other downturns in our past?
Well, I think this is completely unprecedented. We've never seen an event like COVID before, where almost every company is struggling because of it. And I think that because they're all struggling with it, we're going to have to see if we can basically service all these companies that are going to need to restructure and potentially file bankruptcy at the same time. And there's talks about needing to basically flatten the bankruptcy curve because of how many bankruptcies may happen at the exact same time. So we've never seen anything like this. In addition, companies are saddled with almost double the amount of debt now than what they had in the 2008 downturn. And so that's going to be another important aspect of this. So not only we're going to have to figure out a way to restructure more debt, we're going to have to figure out a way to get, to save much more companies that are going to have to file.
Thanks. Robert, is there anything you'd like to add?
Yeah, I think Brandon did a good job. We've never had a situation, excuse me, in which the supply and demand for a majority of goods and services in the economy was so suddenly disrupted. And I think that it's also, this downturn will be unique in that the pace of recovery will be determined by people's response to the virus, not necessarily by stimulus or monetary policy. As long as a majority of Americans are not willing to or not able to go to fully open restaurants, movie theaters, shopping malls, conferences, vacation spots, etc., we really can't fully recover. So I think the recovery from this will really be unusual and not something that is going to be very easy to predict.
Thanks. Sarah, next slide, please. So Robert, what has the impact been on the middle market?
Well, there's very interesting results from the National Center for the Middle Market, Ohio State University survey. Now, this survey was taken 2 months ago. So it was taken in late March. We were still in the early going. But even at that point, about 1/4 of respondents felt that COVID-19 would be catastrophic for their company, while more than 3 out of 4, as you can see from these bar charts, felt that it would have a negative impact on their business in critical areas such as revenue, employment, supply chain, and cash flow. Government programs are replacing some revenue for now, but really not 100%. And this isn't stimulus money. It is really just relief money to help companies survive.
Thanks. Sarah, next slide, please. So, Michael, what have you been hearing on your end?
So Chad, at Armanino, we've been seeing varied impacts on our clients from COVID across both industries and regions. As Brandon mentioned earlier, this is different and people do need a different approach. As an example, pharmaceuticals, light manufacturing, home delivery, technology, those industries are okay. Right now, Netflix, they just reported the stock is up 20%. On the other hand, heavy manufacturing, hospitality, entertainment, oil services are down. Roughly half of the new unemployment is really coming out of the retail, hospitality, entertainment, and related sectors. And regionally, take Texas, for example. Houston certainly is suffering heavily because of oil and gas, and we're seeing bankruptcies quickly climbing there. While on the other hand, Dallas is more impacted by retail hospitality, and we're only starting to see bankruptcies showing up there a little bit more slowly, as Robert had indicated, as people are getting through the stimulus money and getting through some of the other elements. So it really is varying across.
Thanks. Sarah, can you, next slide, please? And so, Michael, why don't you take us through kind of this path through uncertainty, if you will?
Certainly. So, overall, to get through this, the most important thing for a company is to take control of their destiny. And we feel the best approach in doing that is really to go through this path by first doing an assessment and then building a plan, implementing that plan, and then making sure that they monitor the plan as they're going through it. As we talked about, you've got to do the assessments. You got to understand where you are right now. And then when you're developing a plan, you've got to be looking at that, asking a lot of questions about your business, but it's a reset opportunity. Finally, implementation is critical. Just because you have a plan, you need to be able to implement on that plan and also be monitoring as you're going through. This is a challenging time because in many cases, when you build a plan, you have a good historical base to look at, but you also have some clear vision about what the future is going to look like. So it's really critical as you're building these plans that it's in some ways, I hate to say, a plan for a plan. Next slide, Sarah. So the first step is to do this assessment. We think it's really important to understand where you are today so that you can build from there. When we start an assessment, the first thing we do is a waterfall. We want to look at the details of all the assets and liabilities, including contingencies, things that you don't normally see on the balance sheet, such as open POs. And really what you want to do is put a stake in the ground to know where your starting point is. From there, we typically build what I call a 13-3 cash flow plan, which is 13 weeks plus an additional 3 months. But the plan is going to be different on cash flow. It's a direct model cash flow plan. It's not your typical plan. You want to show all your cash collections and expenditures, but as they're happening in real time. The cash plan also needs to be very conservative and more from the bottoms up. As companies are get in trouble when cash runs out, so we're seeing that people are starting their plans with a significant reduction, call it 25 to 30%, just to be conservative, since it's going to be a lot easier as you go through this and have to adjust to be able to add things into your plan. If you only do a less conservative plan to start, then when you all of a sudden have to do additional reductions or further changes, it becomes more and more difficult because you really haven't built it from a bottoms-up perspective. So next slide, Sarah. So let's talk about building the plan. You need to consider a lot of factors when you're building the plan. Most companies, as you can imagine, primarily are going to start by focusing on wages, but you need to go deeper than that. Consider this as a reset, an opportunity to recast your business, one that you don't normally get. You can look at closing locations, changing prices, maybe switching to alternative markets, improving some of your processes, and even getting rid of dead weight. Just because you did something historically doesn't mean that you need to do it now. There's an opportunity because everybody in the market is resetting and they're trying to deal with this. And so they're expecting you're going to be doing the same, but you only have one chance right now to really get it right. And so it's very important to do that. You also need to consider the impacts on your customers and suppliers. When will they come back? What are they? And are your suppliers going to have the product? You also want to think about your taxes and other credits. A lot of people forget that they should be talking to all their advisors, but we certainly know with our team, we get our tax advisors involved really well because they understand there are additional credits that you can happen, whether it's empowerment zones or other things. There are also NOL carrybacks with the changes in the CARES Act. And then there are just the impacts of restructuring. Whenever you're doing a restructuring, you're restructuring your business and it can have both negative and positive impacts, and you want to make sure you understand what that is. As we're going to talk about later too, is you need to identify opportunities to renegotiate and restructure your obligations. Robert and Brandon will be discussing some approaches later as we go into this presentation. And finally, not all plans are going to work, and you got to be realistic, but in cases where you see going through the plan that it's not going to be working, you need to consider whether you should be doing an accelerated sale, maybe a business wind down, or even a soft landing or exits. But the point is, you need a plan for that too. Overall, as was pointed out earlier, we need to move quickly right now. You have a window of opportunity. Everybody's trying to understand where things are, but it's very important to move very quickly and be objective and realistic in your plan. Be careful not to just accept the same old assumptions you've had without asking some additional questions. Just because people have said it before doesn't mean it's right, and it's good to drill into those a little bit. You also want to be sensitive to people's agendas. They may come back, and if you said a 10% headcount reduction, they may reduce it, but they may reduce 10% of the people, but just getting rid of lower wage people as opposed to really 10% of the cost, which is more important. You also want to make sure that you've got metrics in your plan, so that you're going to be able to adjust your assumptions as you're going through, and you can track your projects and make changes as the circumstances change.
Thanks, Michael. Next slide, please. So how will your recovery look? I mean, it's going to be different for everybody. Very limited number of people will have kind of the hockey stick type of recovery. And it'll be more of a U, and we don't know how flat the U will be potentially, but it's going to vary by industry, by geography, and ultimately influenced, as Robert spoke earlier, by just customer behavior. When do things get back to quote unquote normal? So the importance of acting quickly is very important to keep your options open and to embark upon different strategies. So next slide, please. Brandon, why don't you give an overview on kind of the strategic options companies have now?
First, I want to talk about how we need to change the dialogue when people hear the word bankruptcy or restructuring. For some reason, most people think that when you file bankruptcy, your company's immediately destroyed, fire and brimstone rain down on you, and your life is ruined. But that's not really actually the case, and that's only if you liquidate under Chapter 7. Chapter 11 is all about reorganizing your business so that you can have a fresh start after your plan is confirmed. And restructuring is a way to restructure your debt, bring in junior capital, and all sorts of other ways to allow you to cash flow and basically to overcome the challenges that you're facing. So what I want people to think about when they hear bankruptcy and restructuring is it's a strategy, and it's a strategy that your company should be utilizing right now to see if there's ways that you can maximize your profits. If you're not trying to do this, you're gonna wait too late, and then you're gonna foreclose a lot of options that you would otherwise have.
Thanks, Brandon. Can you walk us through the kind of this waterfall of possibilities here as well?
So when you bring in a financial advisor or bankruptcy attorney, what they're going to do first is they're going to see if there's any minor changes that they can make to your company that would allow it to cash flow. If that's the way that you're supposed to do it, that's the easiest way. But unfortunately, sometimes you have to renegotiate debt covenants with your secured lenders so that you can continue to draw upon your line of credit. And that's obviously something, one of your restructured advisors would help you with. Another option is to bring in junior capital so that you bring in the liquidity that you need in order to operate. Another option is to renegotiate your debt. So that's where you're trying to extend out your payment terms, lower interest rates, potentially refinance in order to make those payments, somewhat feasible for you to continue to make over the period of the duration of the note. Now, if you're not able to do those types of things out of court, then what I recommend is filing a Chapter 11 bankruptcy to force all these people to the table. And it's somewhat like a forced mediation where an automatic stay prevents anyone from going after you. And it allows you time to put a plan together that allows you to pay these creditors over time in a way that, you know, makes sense. Now, the last option obviously is a liquidation, which we try to avoid. And that's after we've exhausted all other attempts. And a liquidation is essentially, you know, it's a fire sale. So you would file Chapter 7 and basically hand the keys over to a Chapter 7 trustee and walk away. Now, I have had clients say that that's not always a bad thing. And in fact, some of them find it refreshing that they're able just to walk away so quickly. But, you know, it's obviously for those companies that have no way to reorganize or restructure.
Thanks. Next slide, Sarah. So Robert, what are some of the common pitfalls or the most common pitfall in terms of forecasting recoveries for companies?
I would say, Chad, probably too much optimism. We know that Americans, and entrepreneurs especially, are optimistic. Looking back at that middle market survey in late March, 39% of the respondents believed they would be back at 100% by the end of April. And almost 2/3 thought it would be the end of June at the latest. So by the end of June, 2/3 of the companies thought they would be back at 100% of pre-COVID operation level. Now, in hindsight, we know that few of these companies are back to full capacity, nor will they be 1 month from now. And this is the real danger businesses face in being too optimistic, because this optimism can lead to inaction. And inaction allows you to run out of cash and your options basically evaporate. Next slide, Sarah. Thank you. So you've put your plan together. You figured out what your exit curve will look like. And now you're ready to get your balance sheet in order to support your recovery for your company. Let's talk about some of the easier things that Brandon referred to earlier, which is renegotiating covenants or restructuring your senior debt terms. Estimates are that between 50% and 70% of companies with financial obligations, that's debt, leases, etc., will have to undertake some sort of negotiation or restructuring. The more fortunate will only have to renegotiate their debt covenants or minimally restructure their debts. So let's look on this slide at what they can expect. Now, obviously, commercial banks anticipate that many clients' loans will need some sort of restructuring. They anticipate that they will really happen after the June covenant reporting cycle. Most covenants are reported on a quarterly basis. So June 30th, during July and early August, the covenants get reported, and they anticipate that many of their portfolio companies will be out of compliance. Any sort of restructuring of your covenants or maybe your terms will usually result in higher rates because you will be a riskier company for them. So you can anticipate maybe a 50 basis point to 1% increase in whatever your loan terms are. The banks have to focus on senior debt and overall leverage multiples now. A lot of that's driven by regulatory issues that are out of their control. And as EBITDA recovers, they're going to want to look at debt service coverage ratios. So the depth of drop, the shape of recovery, and your lender's confidence in your projections will really drive their decisions on how they will work with you. One of the things to think about And clearly this is only for companies for whom bankruptcy is a true consideration, but your negotiating power in restructuring your debt and with all your creditors, one of the big levers that you have potentially is bankruptcy, but only if it's a credible threat. Next slide, please. So, in some cases, the senior lender will require you to get additional capital. And this happens when the decline in EBITDA is too great or the recovery is projected to take too long to fall within the bank's parameters for the amount of money they have outstanding to you. There's a variety of structures out there. There's all types of debt and equity that are available to companies as long as you can show, again, through your projections and all that work that you did, that you have viable business prospects going forward. Structures, we've seen very, very flexible structures out there in the market. But I will say that junior capital, be it debt or equity, is going to be much more expensive than you're used to paying at the bank, but certainly less expensive than losing your company. So let's walk through an example. If you can, thank you. Let's take a company that had pre-COVID-19 EBITDA, and that's earnings before interest, taxes, depreciation, and amortization, of $5 million. Their June 2020 EBITDA run rate is $3 million. So they're going to do $3 million annually as of June, down from $5 million run rate. They don't anticipate returning to that $5 million run rate till December 2021. So that's an 18-month gradual return to 100% operations. They currently have a $13 million senior term loan at LIBOR plus 350, and there's no floor, there's no minimum interest amount on that. And they have a $4 million revolving line of credit, LIBOR plus 250 with no floor. Now the bank has said, we can't live with your $3 million EBITDA gradually returning back to 5 for 18 months. We are comfortable loaning you $7 million on the term loan, but it's going to cost you more. We're going to bump the interest rate by 1%, and there's now a 6% minimum interest rate. We're going to reduce your revolver from 4 to 3 and also bump the interest rate there with a 4.5% floor. So what is the company to do? They need money, right? And the bank has said, you've got 90 days to do this, or we're going to kick you out of the bank and call your loan. One possible solution, and I do want to emphasize this is just one possible solution out of many. The company goes out and gets a $5 million 2-year interest-only mezzanine debt loan. So it's underneath the bank, subordinated to the bank. And then in the 3rd year, you start amortizing that loan, but it's a 5-year amortization schedule. So it's something that they can afford to do as their EBITDA recovers and hopefully grows. There's a balloon on that in year 5. Now it's going to cost them 12% cash pay interest, 4% accrued interest, and the lender is going to want an excess cash flow sweep. In other words, if you do better than you projected, they want to pay this down. In addition to the $5 million debt, they're going to pick up $2 million in preferred stock with a 6% cash dividend, a 6% PIK dividend, so accruing dividend. But you don't want them in your company forever, and they don't want to be in your company forever. So you can either call their stock after year 5, or they can make you take them out after year 5. And we've been successful in the past in getting a floor and a cap on how much money they get, what the value of that stock is at the end of 5 years. And these companies, and let's assume in this case that both of the 5 million and the 2 million were from the same company. So they're looking for a blended return on all of that $7 million of 20% internal rate of return. So that's just, again, one example of what can be done in the market currently.
Thank you, Robert. So next slide, please. So Brandon.
Robert, actually, Chad,
oh.
Robert, one question that we saw from the audience, which is, how do you think the banks are going to be this time around versus historically when they were more aggressive?
Well, that's a great question. There's sort of two sides to that. On the one hand, they're going to be faced with a much greater number of companies, I think, that have problems than they saw in the past. And problems that honestly are outside the company's control. On the other hand, the regulations and restrictions that banks are under are much tighter than they were back in the previous recession of 2008, 2009. There were a lot of laws passed between then and now restricting how much leverage a bank client could have and things like that. Now, unless those are changed, relaxed in somehow or waived, the banks will be forced to reduce their outstandings to a lot of these companies based on the company's current operation level and profitability. So again, it's going to be a rush to the bank to get there early. It's like the PPP, get there early because it's going to get crowded.
Thanks, Robert.
So Brandon, why don't you, for the more significantly distressed companies, kind of walk through potential outcomes?
Thanks, Chad. So when I get called from a company, you have to figure out where they fall within these different outcomes. Even though the bankruptcy code is extremely complex, you can kind of boil down where a company will end up into 4 different scenarios, which we've listed as outcome A, B, and C, and D. Now, so the outcome A is what Robert and Michael have discussed, and that's restructuring out of court, whether it be restructuring the debt, renegotiating loan covenants, getting forbearances, maybe getting a standstill agreement with your landlord. It's essentially a non-judicial process where you're able to work out a deal or an agreement with all of your different creditor constituents. Now, the way that you can get it to work is that you have to threaten bankruptcy and really use bankruptcy as leverage in order to get them to negotiate. If they don't believe that you're going to file, it may not be likely that you can restructure out of court. So you have to sometimes fill out schedules and statement of financial affairs and send it to the creditor just so they know what they'd be looking at if you were to file. So that's it's always an option, but sometimes it doesn't pay off, and that's what leads you to outcome B. Outcome B, you tried to negotiate with your creditors out of court. For some reason, it didn't work out, and so then you have to figure out if Chapter 11, is where you should be headed. Chapter 11 is a plan of reorganization, like I mentioned earlier. It is all about putting a plan together to pay your creditors back. You have 120 days after you file bankruptcy worth of exclusivity to put forth a plan. That means during exclusivity, no one else can put a plan of reorganization together. So only the debtor can do that. Also, after you file, the automatic stay will protect the debtor from any kind of litigation from its creditors or collection efforts. So it gives them, time to kind of work through their issues. A plan of reorganization requires payment as to each class of creditors. The classes are separated by a similarly situated creditor. So secure creditors are usually in their own class because they have specific collateral that's attributed to their loan documents. Then you have general unsecured creditors. Now they're normally grouped into the same class. And then you have equity interest as the bottom class. Now you have to have one impaired class of creditors, which means that they're not getting paid according to contract terms, to vote to accept your plan. And that's where the magic happens. So usually you can come into bankruptcy with a secured creditor and kind of smooth talk them into voting to accept the plan because it's in their best interest to do so. So you get one impaired class of creditors to accept your plan, and as long as everyone consents, then you basically have a plan where you maintain your equity interest, and you have a plan of reorganization that pays off your creditors over a 5 to 7 year payment term, depending on how long the court will allow. And it obviously is going to help these companies that don't have the ability to extend out those payment terms if they're under a note that is obviously has more tighter payment terms. So that's option B. Now option C is where it gets a little bit difficult when you're trying to put a plan together to get one impaired class of creditors to vote to accept it. What happens is you have a class of creditors that votes to reject your plan. At that point, you can either find ways to work around what their objection is. It's probably because you're not paying them in full or according to contract terms. But you can basically compel them to accept treatment below what their contract term was through this process called cram down. So you're able to basically cram them down over their objection. And a lot of my clients love the term cram down, and they try to utilize it if they can, but I'll tell you why sometimes it's problematic here in a second. So what you normally do is if a secure creditor comes in and objects, and you have to force them to consent to your plan by cramming them down, you usually pay the secured creditor the value of their collateral, which sometimes is hotly disputed. And you normally will require some type of valuation expert. Their deficiency will be put into the general unsecured class to be paid over time, unless they elect 1111B election or 1111B election, which I don't really want to get into today. But that's generally what happens with a secured creditor. If you're cramming down the unsecured creditor class, that means you're paying them essentially pennies on the dollar. Which obviously you can do, but the problem is when you cram down creditors, the absolute priority rule will prevent the equity interests from maintaining their interests, and in fact they'll be canceled through the plan because of this absolute priority rule. Because once one of these top layered classes aren't paid in full, every class below them can't be paid, and so that's usually what kicks out your equity. Now you can remedy this by putting in new value for money's worth for the equity interests that were canceled, and that typically requires either it to be opened up at auction to be sold at fair market value for the equity interest that you're wanting to maintain, or you can put a plan together which shows new value coming in, and you can test the market by terminating exclusivity and opening up other creditors' options to file a plan. But so there are options out there if you want to cram down creditors, your secured creditors down to the value of their collateral, and to pay unsecured pennies on the dollar and still maintain your company. But it's a little bit complicated as to how you're going to put in new value, how to value what your interests are, and then how you're going to make sure that it's fair market value. But there's options there, and I want to make sure everyone realizes that bankruptcy is a strategy even when you're trying to cram down your creditors. The last scenario is typically the one where people think of when they hear bankruptcy, and that is a forced liquidation sale. This is obviously after you've tried to put together a plan that would meet the requirements for feasibility and that unfairly discriminates against the different classes, and you're not able to put a plan together that meets the requirements under Section 1129, then your options at that point are somewhat few and limited. And what you are left with is a liquidation under Chapter 7, or you can do a sale through Section 363 of Chapter 11, which allows you to sell either all your assets as a going concern or piecemeal through a process. It's a public auction process typically that allows the buyer to buy those assets free and clear of all liens and encumbrances. And obviously you can't do that outside the bankruptcy code. Now, after you've sold all your assets in Chapter 11, then depending on what jurisdiction you're in, you can either do a structured dismissal, a conversion to 7, or a liquidating plan that dictates how the proceeds of that asset sale are to be distributed to creditors. Obviously, that would be more expensive, but selling assets in a 363 auction process with the stalking horse bidder are going to maximize the value for those assets. A liquidation scenario under Chapter 7 is going to be a fire sale of those assets. There will not be a marketing effort. And typically what happens is the value is a lot less when you do a Chapter 7 liquidation. So those are your options. Now, one thing I'll say is that even in a regular Chapter 11 case, sometimes it makes sense to sell certain assets that are not profitable. And you can still utilize Section 363 to do that, even if you don't plan on selling the entire business as a going concern. So that option is there. The other thing I'd like to talk about is tax issues and implications. Generally, mainly the tax issues come up in general partnerships, because anytime you cram down creditors or pay them less than their contract terms, you have cancellation of indebtedness income under Internal Revenue Code Section 108. That passes that cancellation of indebtedness income down to the general partner level. And so that, if you're a general partner in a partnership, these are things that you'll definitely want to look at and talk to your bankruptcy attorney before filing. And that brings us to our next slide. So the new Subchapter 5 is a complete game changer. This was passed later in 2019, but became effective February of this year. It was originally capped for debtors who had less than 2.7 million of both unsecured and secured debt. That cap was increased to 7.5 through the CARES Act, which was, I think, a month and a half ago. And that limit will stay like that for a calendar year. Now, it's for the way they calculate it. It's for non-contingent and liquidated debt. So there's some games that you can play there if you're a bigger company to qualify, as long as those debts are non-contingent and liquidated, meaning they're not an unliquidated debt through some type of lawsuit or something. Now, the reason why Subchapter 5 is such a great tool is because it will expedite the process for smaller businesses, and it should reduce the cost. Now, there will not be a creditor committee unless the court appoints one for cause. So there's not going to be grenades thrown in your case by a creditor committee. And only the debtor can propose a plan of reorganization. There will be no disclosure statement. There will be no ballots. Creditors will not be able to vote on your plan, but a Subchapter 5 trustee will be appointed to help calculate what your disposable income is. Under Subchapter 5, the debtor is supposed to pay its disposable income over a period of 3 to 5 years. If those payments equal the total amount of debt that the debtor has, the debtor will receive a discharge prior to making those payments when the plan is confirmed. But if the debtor pays, the disposable income is much less than what its debt is and essentially crams down its creditors, that disposable income after 5 years if the payments are made, that's when the debtor would get its discharge. It won't get it on the effective date of the plan. And so one of these main things in subchapter 5 is that there's no absolute priority rule. It's just whatever your disposable income is, that's what the payments are, or consist of. So there's no having to put in new value to make sure that you can maintain your equity interest. Like I said, there's no absolute priority rule. You can pay creditors whatever your disposable income is. So even if you're cramming them down, you'll still get your equity piece at the end of the day. It's never going to be at risk in a subchapter 5 like it traditionally would be in a regular chapter 11 case. Now, you have 90 days to file a plan. You can get that increased by cause, and I think most people would cite COVID as cause currently. But one of the main issues that I've been having with my current clients is whether they should file subchapter 5, which requires them to be in and out of bankruptcy within a period of 3 to 4 or 5 months, or whether they should file in regular chapter 11 and utilize a much longer runway before they get out of bankruptcy, and then they have to start making plan payments. No one knows when a vaccine is going to be ready. No one knows when the market's going to rebound. And so some of my clients would prefer to file regular chapter 11 to get much longer runway in a chapter 11 process, even if there's an absolute priority rule. And that takes us to our next slide.
Thanks, Brandon. So when should you call a counselor or advisor? And the short answer is now. As we mentioned earlier, these are unprecedented times. The whole system is going to be strained, and the number of experienced, competent professionals that can help out is going to be limited. And quite frankly, the demand will likely exceed the supply in very short order in the next 3 to 6 months. So it's not only the lawyers, the bankers, but there's as we mentioned, there's tax implications throughout this whole thing. So it is a complex process, and to keep your options open, it's best to do it while you still have some cash, and it'll leave you more desirable options. And if you wait too long, you might be stuck with the least desirable option. So again, the quicker you get to the diagnosis, the quicker you're going to get to potential scenarios and strategies. So I'd like to turn it over. If anyone has any questions, feel free to chime in. And we do have some questions. So I think I'll start with Michael on this one. And Michael, can you kind of give us an overview on what the typical start to finish time frame would be for really any aspect in this process, whether it's raising capital, restructuring, or bankruptcy that you've experienced?
Yeah, Chad. I think the issue is there's a lot of variables in all the different situations. But I would say that in general, what happens is when you're building that plan and putting your assessment together, you want to look at all those factors to be able to weigh in how the different processes are going to affect it. As an example, raising capital, if you've been out in the marketplace or you have ready parties that are there to lend, that's going to be able to move more quickly than if you haven't been out in the marketplace at all or looking for capital. So I think that it is a process. It's the one thing is that everybody thinks, oh, this will happen today or this will happen tomorrow. It's going to take some time. What you need to do is you need to make sure your plan, you have as much cash as possible to start, because that's going to be a big dictator about your runway. You can't be in bankruptcy and restructuring and not have and run out of cash. So you've got to have the cash to do it. And then really it's about driving people rather than waiting for them to respond, setting deadlines, setting timelines, putting stakes in the ground, because that allows you to force it. We've seen cases where we've been brought in and been able to go into a situation The lenders weren't happy. We took it over. We ran a sale process and we sold the company in 35 days. And then the company, the employees and all that, the people went on for it. And then we wound down the remaining structure. And you've also seen companies that have been bankruptcy for years. So it's really going to vary on the specific circumstances, but but a lot of it will be dependent on how well you plan ahead of time and how much cash you're going to have as you're going through that.
Thanks, Michael. We got a couple of questions in related to subchapter 5, so I'll turn it over to Brandon. But so on the subchapter 5 first, is that available to companies, public companies, companies traded in public markets? Subchapter 5.
Yes, I think that's not one of the restricting requirements. It's mainly that you have the debt load below 7.5. You also can't be a single asset real estate debtor, but there is no requirement that you be private.
And for under subchapter 5, it appears creditors are pretty much out of luck. Is there any reason a client would file regular chapter 11 versus 5? What benefit is there?
Well, so like I said earlier, if you're a debtor that wants to maintain paying everyone in full through your plan, and you just need time for the market to change, you're not going to get that time in subchapter 5 like you would in a normal chapter 11 case. So for instance, if you are a hotel chain or something in the hospitality sector that needs a longer window, and you want 12 months in chapter 11 before you start making plan payments, subchapter 5 may not be the right choice for you. But now remember, that's only if you plan on making payments in full. If you don't, and you're planning on cramming down your creditors to a point where you're going to lose your equity, then I don't think regular chapter 11 will ever be a good idea. But yet again, you have to be prepared to start making those payments within 3 to 6 months after you file.
Got it.
There's also, Chad, the element which is that because the subchapter 5 is so much faster and streamlined, the costs are lower, and that basically inures to the benefit of the creditors, as well as the fact that by being a fast process, it allows the company then to pivot coming out of it and be ready to move forward. I think one of the things that happens historically in a lot of 11s is they don't get reorganized, and you end up with distressed sales, 363s, things like that, where often the creditors don't do as well. The assets are sold out, and then creditors are fighting over, we'll call it the carcass, and there's a lot of cost to that and everything else. So I think one of the things for creditors as they're looking at it is, if there is a good plan and you can move quickly, that's going to be a better outcome typically than if something languishes and people are fighting about it, as well as just kind of an expedited sale in a bankruptcy. Finding a home for it and getting value out of that value is important.
But remember, one thing that you have to take into account is that you have to, if you're not making payments in full over that period of time, you won't get a discharge until you complete those plan payments. So in that sense, it's kind of like a consumer chapter 13. If you want to have a discharge on plan confirmation under section 1141, you're not going to be able to do that unless you pay everyone in full through your disposable income. So that's just one thing to consider. If you want to make plan payments for 3 to 5 years, and after you successfully finish those, that if you're okay waiting till then to get a discharge, that's something that you'll need to consider.
Got it. Thanks, guys. We got another question in, and it's related to, are there any expected impacts to bankruptcy proceedings stemming from PPP activity, such as outstanding loans, whatnot?
So this issue comes up with the debtors that were trying to get PPP loans while they were currently debtors in possession, under Chapter 11. I know there were decisions going back and forth, one from Judge Jones in the Southern District of Texas, where he basically compelled the Small Business Administration to follow through with the CARES Act and provide that PPP loan to the debtor. So I am seeing more of those cases. One of the issues that I talked with someone yesterday at the SBA was, a debtor case I'm about to file, they want to make sure that they'll get the reimbursement for the the amounts that they're able to spend with their PPP loan after we file bankruptcy. And we were trying to make sure that there was no obstacles from doing that. So I did not speak with their legal counsel, but the SBA said they didn't have a position as to that at this moment. So I would hope that it would be kind of a breach of contract for them to not allow that the PPP monies to be reimbursed, if just because they filed bankruptcy. Now, so I think we'll have to just wait to see what happens there.
And Chad, as you know, the Armanino has a pretty deep PPP team. We've been working with a lot of clients, helping them on navigating through them, both getting the monies as well as understanding what credits they can get and working through that. We ask our people that question a lot. And I think there are a lot of challenges right now, and information is still coming out. As an example, there was another court yesterday that indicated that they weren't going to be in a position to require the SBA to give PPP loans to companies that had asked for them but were in bankruptcy. So a lot of moving parts around it, and definitely one of those items that is a hot topic and needs to be asked. There's also a question about whether you can use the proceeds in the bankruptcy for a different use than was intended under the PPP, and whether that breaches the certification. Those are tough questions, and there aren't easy answers for them right now. And so I think there's a lot of people who are looking into those, and it's definitely one of the reasons that you need to stay on top of these type of things.
Great. Thanks, guys. So, Robert, another question for you. What is the environment like right now in terms of raising alternative capital? Can you comment on that?
Sure, Chad. Let's start with the senior banks, commercial banks. They always, of course, say that they're open for business and making loans. The reality is right now is that the door that's open is very small and is only open a crack. They are only making new loans to a limited number of very, very attractive companies that are pretty much not impacted by COVID-19. When you look at non-bank capital providers, and there has been an explosion in non-bank lenders and equity providers in the past decade. There are thousands of them. But out of that universe, not all of them are willing to put capital into distressed companies. Now, more and more are, because they understand that the majority of companies are going to be in some form of distress. But there is capital out there of all different stripes, everything from they'll take out the bank and do the entire capital structure. They'll put in just some equity. They'll put in just debt, if whatever's needed. So it's very important to understand who those players are, what their appetite is for different industries, what their appetite is for different levels of distress, and what their goals are in terms of when they want to get out, what their current pay is, and all those other factors. So there is money out there, but it's a complicated landscape to try and get through.
Thank you. So this concludes the need for speed and why you have to act quickly and diligently and make the best decision to keep your options open. And thank you for joining. Sarah, I had one other question. Maybe you can comment on whether this is recorded and if slides are going to be available.
Yes, thank you, Chad. So we will be sending you a recording and the deck 24 hours after this as we end. So keep a lookout for an email from myself, and you will get all the content then.
Great. Thank you very much. Thanks all for joining. Hope this was helpful. And we're happy. Our emails are included in the presentation as well if you have any questions after the fact. So thank you very much and have a great day.